All right. My name is Chris Campbell. I'm a practice CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about home ownership and the tax benefits of home ownership. And maybe I should correct it to say the lack of tax benefits of owning a home. It's kind of been a forever thing. Think it was always instilled in folks. Well, there's such great tax benefits in owning a home versus renting. And I would say up till about 2019 or so, that was the case. But when Trump came into office, what year was it? 2016. And one of his big things that he did during that term was there was a big overhaul of the tax system. So what prompted me to do this was because I've talked to a number of clients, and it's usually around that time when they recently become first-time homeowners, and they were always told, "Oh, there's such great tax benefits of owning a home." And when they actually do their taxes for that first time as a homeowner, they get pretty surprised that the benefit wasn't as great as they thought it would be, being that they are a homeowner. And traditionally, there were some great benefits of home ownership up till about 2019, and that changed. And why did that change? Mainly because of the Trump tax law changes. So when Trump came into office, one of his big sweet things was to make drastic changes to the tax code. And unfortunately for many homeowners, this change drastically reduced the tax benefits of home ownership, mainly because the deductions that most homeowners would normally take, that they were traditionally taking, they got reduced with this tax law change. So it caused quite a stir with homeowners, and it drastically reduced the tax benefits of home ownership. So I wanted to walk through and wanted to explain how and why this was the case. So the first thing that was affected was the ability to deduct property taxes, right? In the past, that was one of the big things that, look, you can deduct your property taxes on your home. So to an extent, most homeowners weren't as sensitive to maybe high property taxes because it was always, well, you're going to get a deduction for it on your taxes. This drastically changed now with the tax law change. And in the past, there was no limit to the amount of property taxes that you can deduct. So your property taxes, as long as it was your main home, was $30,000 a year, you can deduct $30,000 a year. Your tax, if it was $50,000, you can deduct that. That all changed with this tax law change because they placed a cap on the taxes deduction of $10,000. And keep in mind, this $10,000 includes all taxes paid. So that includes property taxes, state income taxes. Those are the two main ones, and some sales tax. But the two main ones are property taxes and state income taxes. So between those two, no matter how much you paid, you only get a $10,000 deduction. Now, most folks who have pretty decent paying jobs can easily pay $10,000 a year in state income tax. And then it's even easier to reach if you are in a jurisdiction that has city taxes. So if you live in New York City, where you pay state and city taxes, it's pretty easy to hit that threshold of $10,000 relative equivalent to simply upon your income taxes. So if you've already accumulated $10,000 in state and city tax, then any property taxes that you're paying once you hit that 10,000 cap doesn't do anything for you. So if you're paying $15,000 a year in state and local income taxes, then you are getting absolutely zero benefit of the property taxes that you're paying on your property. So quite damaging. Again, it removes any benefit of paying property taxes. So that's the issue with that. The other benefit that was lost was mortgage interest. So in the past, or whatever interest you were paying on your mortgage, it counted as a deduction. I don't think there was a limit prior to 2019. So as long as it was your primary home, you were good to go. I don't think there was a cap. So if your mortgage was $1.5 million and you were paying interest on a $1.5 million mortgage, as long as it was your principal home, no problem. You get that deduction. But now with the tax law change, there's a cap. There's now a cap on the maximum mortgage that you can deduct interest on. If your total outstanding balance is $750,000 or less, not the price that you pay for the home. It's the actual mortgage balance, the balance that you have on your mortgage. So if it's $750,000 or less, then all of the interest on that is 100% tax deductible. If it's over that, then you get a proportion of it deductible. So you don't get 100%, it's only a portion of it. So to make math simple, if you had $1 million mortgage, the limit is 750. So roughly 75% of the interest that you paid on that mortgage would be deductible. The other 20 is just lost. You get no deduction for that. Now, I guess the good news is that as you pay down that mortgage and you finally get to the 750, then eventually it will be all 100% deductible. But while you're paying that down, any portion over the 750 is not deductible. But as you pay it down, then the percentage that is deductible will become higher and higher as you pay down that mortgage. But until then, anything in excess of the 750, not deductible. So that created another issue. The third component was the home equity line of credit. So in the past, there was a great tax deduction for people to take home equity lines out on their homes and pay whatever you wanted to pay for. So let's say you wanted to go buy a new car and simply take a home equity line out, write a check for the car, pay for the car, and the interest on that was tax deductible. So it didn't matter what you used the home equity line for. You do whatever you want. Whether you want to go on vacation, you want to gamble it away, as long as it was funded and you used your home equity line of credit, the interest on that line was tax deductible. So a great way to finance things while being able to deduct any interest that you're paying, relatively low interest. That all changed with the Trump tax law changes. You can only deduct that home equity line if the proceeds were used to either build or improve. So you can't go do whatever you want with the money and still get the deduction for it. It has to be specifically tied to either the building or improvement of a home. So another loss deduction there. And then the last thing is that although they created a lot of these restrictions to combat that, or I guess to balance that out, they actually raised, and I think you'd say they almost even doubled for the most part, what's called the standard deduction. So the standard deduction is a deduction that the IRS gives everybody, and the amount depends upon what your filing status is. So I'm filming this in 2024. So if you're single, I think it's about $14,600. And you are married, I think it's roughly about 28,000, somewhere in that ballpark. So everyone gets that automatic deduction. Now, all of these deductions that I spoke about prior, so the interest, the taxes, these are all what's called itemized deductions. And when you are doing your taxes, you take one of the two. You take the standard deduction, which is the amount that everyone is given, the 14,000 and the 28,000 that I spoke about, or you can use your itemized deductions. Now, you would only use your itemized deductions if, when you add everything up, all of those things up that I mentioned, your interest, your taxes, and there's a few other things that get included on there as well, like medical expenses, charitable donations. So if all of those things add up to more than what your standard deduction would be, so if single, we add all these things up, it equals more than $14,000, then you would go with itemized. Otherwise, it just makes sense to stick with the 14,000. Same thing if you're married. Again, it's roughly, the standard is 28,000. So if all your itemized deductions, your interest, your taxes, your charity, so if all those things add up to more than the 28,000, then you will go ahead and use the itemized deduction versus the standard deduction. Now, where a lot of people run into the issues is that even if you add all these things up, it still comes below, especially if you're married. If you add all of these things up, it may not even hit that 28,000 or whatever the threshold is. It goes up every year, and the ballpark for 2024 is roughly 28,000. So if you have all of these items, your mortgage interest, taxes, your charity, so if all of those things are less, and mind you, you're capped at the $10,000 for the taxes. So assuming you already hit the $10,000 cap, if you're married, between your home and your charities, and if you had some extenuating circumstances where you paid a lot in medical bills, if all of those things don't add up to about $18,000, then there's no benefit there at all. You would just use the standard deduction. You'd get more of a tax benefit using that. you get that standard deduction, whether you own your home or you rented your home. And that's the big kicker where a lot of folks don't get a chance to benefit from it because they don't even hit the number in excess of a standard deduction where it even matters to do. So as a result, it is drastically reduced, especially if you're living in a high cost of living area where the taxes are high. A lot of blue states or on coastal cities in New York, LA's, many metro cities, the taxes are relatively high and property taxes are high, home values are high. So it's tough to really get that benefit out. You are as far as how much you can actually deduct. So the thing is, if you're on the market for a home or you have sold a home and folks are talking to you about all these tax benefits that you're going to get from it, you may want to just take a step back and just consider them because the benefit may not be as much as you thought. All right. So that's all for now. Hopefully this is helpful. And if you have any more questions about this particular topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. That's all for now. And I'll talk to you in the next one.